Your retirement shouldn't depend on what the market does tomorrow, and neither should your path to get there. You're listening to 10 Minutes Wealthier from the team at Branning Wealth Management. Each episode, we cover one piece of the wealth planning puzzle because the right moves before retirement are just as important as the right moves during it. Let's get to work.
Welcome back to 10 Minutes Wealthier, the Branning Wealth Management Podcast. I'm founder Jason Branning, and this show is about helping you build a predictable and tax-efficient retirement income plan, one that you can actually count on. Well, last episode, we talked about the big idea. Don't ask the market for permission to retire. We talked about why tying your entire retirement to market performance each year is a problem, and what it means to build an income plan that doesn't depend on what the market does in the near term. Today, I want to get into some of the specifics and mechanics about the most underrated tool in retirement income planning, something that we use every day, but many people have never heard of. It's called a bond ladder. And by the end of this episode, I think you're going to understand why it's the foundation of the way we approach retirement income. Let's get right to it. Here's the question I ask almost every new client I sit down with. If you retired tomorrow and your paycheck stopped, where would your money come from? Most people pause because they've been so focused on accumulating wealth and growing the portfolio that they haven't thought very hard about actually how do I turn this pile of money into a steady and reliable stream of income. And that's no criticism. That's just the message the financial industry has sent to consumers for decades. Save more, invest more, grow it. The income part, surely it'll figure itself out. But what we found is the income part does not just figure itself out. And when you retire, the game changes completely. When you're working and the market drops 20%, you stay invested. Your paycheck keeps coming and you ride it out. Everything's fine. But when you're retired and the market drops 20% or 30%, you still need to pay your bills, which means you're selling assets at the worst possible time when market prices are low. And the money you sell off, that never has the chance to grow back. That's called sequence of returns risk, and it's something that can unravel a perfectly good retirement plan. So what can you do about it? Well, that's where the bond ladder comes in. As we begin talking about the bond ladder, let's just start with what is a bond? Well, a bond is essentially a loan. You loan money to a company, a municipality, or the U.S. government. They promise to pay you a stated rate of interest over a particular period of time. And then at the end of that period, which is called a maturity date, you get your principal back. A bond ladder is a strategy where you buy a series of bonds that mature in different years. So you might have a bond that matures in year 1, another in year 2, and another in year 3, and all the way out as far as you want to go or as far as you can afford. As each rung of the ladder matures, it pays you money. And here's the key. The money is already there set aside for the future. It doesn't depend on whether the market during that future year is up or down. It doesn't depend on investor sentiment or a Fed rate decision or whatever's happening in the news. The maturity date is the maturity date. They will pay you interest, and then at maturity, the principal comes back to you on schedule. It really is one of the more predictable ways to invest for retirement income. We take advantage of this lower risk, predictable, and reliable strategy to build an income floor. A bond ladder is designed to cover a client's essential expenses for a particular number of years, usually somewhere in the range of 5 to 10, but sometimes longer. Think of it as a reliable paycheck, money that you can count on regardless of what the market's doing in the near term. So once your bond ladder is built, your remaining assets are invested in growth, and this will be the stock or equity portion of your portfolio, and those get to stay invested for the long term. We don't touch them when the market drops because we don't need to. Your income for the next several years is already pre-funded and covered. In a year where the market performs well, we may decide to sell off some of the growth from the portfolio and add it to another piece of the bond ladder or rung of the ladder. In years where the market does not do well, we don't have to change a thing. We just have to wait. That's the whole idea. Protect the short term, and let the long term grow. Well, here's where it gets interesting and where I think a lot of people misunderstand how this actually works. When people hear bond ladder, sometimes they imagine one big number. Like, okay, I have $2 million in bonds and that's my safety net. But that's not how we build it. The ladder is not one generic pile of money just sitting there in case you need it someday. Every rung of the ladder is tied to a specific something, a specific year, a particular purpose. And let me give you some examples. Let's say you've got a mortgage with 10 years left to pay on it. That payment is known. It's a predictable expense for the next decade. So we build that mortgage payment into the ladder and all those rungs that will be covered for those years for that mortgage payment, on top of other regular living expenses. Or say you and your spouse like to replace a car every 5 years. Well, that's not a surprise expense. You know it's coming. So in year 5 and 10 and 15, well, there's a piece that's in the rung of the ladder sized to cover that expense. Maybe you've got a child who's getting married soon, or you know it's going to happen in a year or two, and you want to help with that. Or maybe there's a big trip that you've been planning, or trips you would like to plan for each year. You also know that your property taxes are reassessed on a periodic basis. Well, all of these kind of things go into the bond ladder design. Each rung isn't just a year of expense, it's that year of expense plus whatever particular goal or obligations land across that year. Which means your ladder and your neighbor's ladder, even if you have a similar account balance, are going to look completely different because your life is different. Your mortgage payoff date's different. Your car replacement cycle's different. Your goals are different. They are unique to you. That's the part that I really want people to understand. This isn't about just getting to one big magic number and then you're done. It's about mapping out what your money actually needs to do for you year by year for the specific and unique life you're planning to live, and then building a structure that helps deliver on that schedule so that you can ignore what the market's doing in the near term. And that's because it's that specific. It gives you something that a generic number never can, which is the ability to look at any given year and say, I know exactly what's going to be covered. And most importantly, I know why that money is there. I want to be clear about something else. The bond ladder is not a complete retirement plan by itself. It's the income floor, the foundation around which your specific goals and obligations are to be delivered upon. A complete plan also includes your growth portfolio, which stays invested for the long term and as what will fund the future years of the ladder, like the next decade, we hope, as this one matures off. It includes pensions. A good plan includes Social Security claiming strategies, how to maximize those benefits for you and your spouse. It also includes tax planning, how you take income from different accounts in the most tax efficient sequence is quite a challenge. Also, thinking through how you could use Roth IRA conversions. Do they fit in your plan? And if so, how? What's your Medicare strategy? All of these seemingly disparate pieces actually connect. And that's because the bond ladder is there. It's there around your actual life, your mortgage, your goals, your timeline. And it makes the whole plan feel less like an abstract financial exercise and more like this is just how the next several years of my life are going to be funded and will likely lay out. Here's where the car slots. Here's that mortgage payoff. Here's the trip. Here's the wedding. It's all accounted for. And that's what we mean when we say build an income plan that's designed to be reliable regardless of market conditions in the near term. Not predictable in some generic sense, but predictable for your life, the one that you're actually planning to live. When you have a bond ladder in place and you know that your essential expenses are covered for the next several years, something changes for people. They sleep better. They stop checking the market every morning, and they don't call in a panic about a headline they see regarding a correction. Not because they don't care about their portfolio values going down, because certainly no one likes to see that, but it's because they understand that their lifestyle is not going to be held hostage to that. Let me leave you with this. If you've already started thinking about retirement, or if you're already retired, the single most useful exercise you can do is sit down and actually map out what the next 5 to 10 years will look like. Not just your monthly expenses, the bigger things too. When does that mortgage pay off? When do you replace cars? What about trips, weddings, or projects that you know of that are going to be on the horizon? Because once you can see that, and once it's laid out year by year, you can build an income structure that's designed around it, not a generic number. No, it's your actual life, funded on a schedule, regardless of what the market does in the near term. Well, if you want to learn more about how we build retirement income plans and what a custom built ladder might look like in your specific situation, visit us at brandwealth.com. You can learn about how we work, and if it feels like a fit, we'd love to have a conversation. Our next episode, we're going to talk about taxes in retirement, and specifically why your tax rate during retirement years might surprise you, and why the order in which you take income matters more than most people realize. Until then, build a plan that doesn't ask the market for permission. We'll talk to you soon.
The information shared in this podcast is for educational purposes only and does not constitute investment, tax, or legal advice. Opinions expressed are those of the speaker and may not reflect the views of Branning Wealth Management or its associates. Investing involves risk, including the potential loss of principal. This podcast is not a solicitation to invest. Branning Wealth Management provides investment advisory services under Asset Dedication, LLC, an SEC registered investment advisor. For additional information, including our ADV Part 2A and Part 3 disclosures, visit brandwealth.com.